US inflation data reassures the market, but price rise worries are far from over. The Federal Reserve's preferred measure of inflation, the PCE price index, rose by 2.5% year on year in January. That was in line with expectations. But the market still thinks prices will stay high enough that a Fed rate cut is not coming in this half of the year. And President Trump's promised tariffs are expected to push prices even higher. Saidel-Baker is an economist at ITR Economics. Lauren, this number has been something of a relief, of course, but we have seen other recent data showing consumers are again very worried about inflation, aren't they? And their expectations change behaviour as much as the numbers themselves.
Yes, inflation expectations are elevated at the moment. We've really seen a shift in the first quarter of this year. Now, we at ITR had been expecting higher inflation, especially in the back half of 2025. So in some sense, we really see the market kind of aligning with our expectations, aligning with these fundamentals that had been in place even before the Trump administration took office. So I think consumers, as inflation weary as they do see this relatively lower rate of inflation. That's something of a relief, as you mentioned, but we have to keep in mind lower inflation, that is still rise in prices. It's just rise at a slower pace.
And President Trump does appear to be doubling down on those tariff threats, insisting that duties on Canadian and Mexican goods will come in next week. What could that mean for the American consumer?
That is absolutely an upside risk to prices. Many Trump policies are lining up to be inflationary, but that is on top of the fundamental reasons that I outlined earlier. We see higher velocity of money. We see the money supply starting to come back. There's just so much liquidity out there that even if we didn't have tariffs, we have the foundation in place for rising inflation. And I think we have to keep this all in context. We're not seeing inflation rise back to the ultra high levels that we saw this last cycle, or say the ultra high levels of the 1970s and 80s, but a higher than the past decade average of inflation, that would be economically normal. So we're looking for less low single digits, more mid single digits, that 2 to 3 to 4% inflation rate going forward. That is something our economy can withstand. This doesn't have to be recessionary automatically, but it will likely cause a shift in both consumer psychology and potentially spending.
Does this put the Fed in a difficult position then going forward?
I don't know about difficult, but it does hamper their ability to keep cutting rates. Again, we've seen the markets start to come around to this realization that we probably won't get the full 50 basis points of cuts that the Fed had been signaling this year. So we're very likely on hold. We'll see a pause in rates for the foreseeable future. But if inflation does in fact pick up, especially in the tail end of this year, I think we could be talking about rate hikes, not rate cuts by year end.
What about the aims of these tariffs? Is it possible that they could in fact bring some production back to the US, and what consequence would that have?
So there is, at the margin, some potential. I, again, really hesitate to think it would be an outsized impact just because no company is going to invest a huge amount of money, say, build an entire new factory for the sake of tariffs that might only be in place for 4 years. They need a longer time horizon typically for those payoffs. But what we do see is a little bit of protection for existing domestic production. Some firms will use that higher foreign competition pricing to take market share. What we saw, though, during the first Trump administration is many more firms chose to take price, to increase their own margins. When the foreign competition gets more expensive, I can also raise my own pricing. So I would expect to see, again, it won't be an immediate impact. It will be delayed and rolled out over time. But that would be my base case expectation, given what's happened historically.
The other side of the Fed's mandate, of course, is the labour market. This week, we've seen significant layoffs at the federal government sparking some concern. Could that be large enough to make a difference across the wider economy?
Yes, we are waiting to get full numbers, the full impact. I've heard everything quoted from tens of thousands of jobs to hundreds, even 100,000 jobs. But at this point, we just don't know. I think there is some double counting between, say, those probationary workers who were facing layoffs versus those who took the agreement to work and be paid until September. So we don't have hard numbers yet. We're waiting to get that full visibility. I want to be clear, it's not impacting the data quite yet. There will be a delayed release when we see the full effect on things like jobless claims. But this could be one of the largest layoffs that the US has ever seen. So to say that the labor market coming from this very, very tight position, this core group of professional service workers essentially, there could be some localized impacts, especially localized in places like the DC area. But more generally, our labor market is still tight. So there might be skills gaps in certain areas. Clearly, these same federal workers won't be able to just pick up a construction job or a manufacturing position where those skills gaps do exist. But again, overall, we're coming from such a tight position in the labor market that if we just look at averages, if we just look at employment on median, there is some room for a buffer zone.
That was Saidel-Baker of ITR Economics. Don't forget, you can watch more videos on Reuters.com.